Major averages all closing around 1% higher today, but off the highs as the Fed says it is leaving interest rates unchanged as expected. Our next guest says she is looking ahead to the next catalyst for the markets. That's reciprocal tariffs. Saira Malik is Nuveen's Chief Investment Officer, joins us now. So welcome, good to see you. So we're about at the levels on the S&P where we were mid-July, about 8 months ago. Market ended on the highs, but should you be more defensive here based on what might happen in 2 weeks on April 2nd, or have we seen the worst of it?
Well, there's three reasons the markets have bounced from correction territory last Thursday, and that's because of the Fed today. They talked firstly about no more rate hikes. They talked more about rate pauses and rate cuts, which was positive for the markets. They went back to the future and brought back transitory when it comes to the inflationary impact of tariffs. And then they kept on the table 2 rate cuts for this year and 2 rate cuts for 2026. Now, the question is, where do we go from here? I think the next catalyst is going to be the tariff plan laid out on April 2nd. And if we can get that catalyst where tariffs are watered down, or we get more signs of economic strength and not so many signs of the consumer weakening, I think the markets can continue to rebound from here. But we're going to be in a bit of a trading range, and perhaps investors will continue to sell these rallies until we can get more clarity on tariffs, and the next chance for that is April 2nd.
So a big unknown, though, is how other countries will react to what the U.S. does on April 2nd. How big of a factor is that in where the market goes from here?
I think that is going to be the key uncertainty on April 2nd, which is going to be how much retaliation will we see in terms of tariffs. The market already expects tariffs to come into place in areas like Canada, Mexico, China, perhaps Europe. But the question is, how much retaliation and back and forth will we get on that? And who's going to bear the cost? Will it be the consumer or the producer? If the consumer is bearing the cost and we're already seeing decreased consumer sentiment, lower retail sales, then I think this is going to be another hit to the consumer. And the consumer has been the main driver of this economic bull market cycle that we've seen over the past number of years.
Sarah, how much do you think tariff impact is starting to factor into the guidance we're already getting? I think about Five Below reported earlier this hour. The results for last quarter were better than expected, stocks higher. The revenue guidance for full year, though, a little softer than expected. But they did say that they are factoring in tariff impacts already. So I just wonder how much companies are already taking this into account, and thus it's already pricing into the market.
I think the current risk for tariff impacts on companies and consumers is perhaps hesitating or pulling back in terms of their behavior because we're not sure what the real impact of tariffs will be. So I think that could create an air pocket and potentially negative GDP for the first quarter of this year. And remember, if we get 2 quarters of negative GDP, that is a recession. So tariffs could become a self-fulfilling prophecy to create a recession. But the real inflationary impact of tariffs has not been seen yet. The good news is that ex-tariffs, inflation has been trending in the right direction. It was trending to about 2.5%. But we saw the Fed today add about 30 points to their inflation estimate. And whether inflation is actually transitory or not is going to be the key in terms of how the Fed behaves. It is good for the markets to see that the Fed is confident that inflation from tariffs will be transitory, and we still will get those 2 rate cuts this year as well as in 2026. Our expectation is that we get 2 rate cuts in 2025.
It is interesting. We've seen Treasury yields come off as much as we have in these last couple of weeks. Do you expect that to continue here? And why? Why are yields coming off? Is this still the growth scare dynamics, or is there something else at play as well?
I think mostly for yields, it's the growth scare. It's the signs that the employment markets are slowing, the potential concern over the impact of DOGE. Half of the payrolls created in the last 5 years were government payrolls. So the impact of DOGE is likely going to slow the employment markets. We're already seeing that. And then the impact on the consumer from tariffs. Now, on the other side, I talked a little bit about catalysts for the markets. Tax cuts could be a good catalyst for the markets, increased deregulation. And a lot of that we saw earlier in Trump's presidency the first time around. So those are still pending catalysts. But as for the market, I do think you need to stay somewhat defensive. We're likely in a trading range until we get one of these catalysts. And that's why we like companies like utilities and NiSource, which are companies that are somewhat defensive during these periods of slower economic growth and lower rates.